Hi, folks. Dan Bird here on the 8th of January. Tomorrow, the markets are closed. I've been having some trouble with my internet connection, so I'm going to try to make this quick and hopefully it'll last. I'm not a financial advisor. This is for educational purposes only. I do not make recommendations on what to buy or sell. Tomorrow, in memory of Jimmy Carter, markets will be closed January 9th, 25. Let me first, I'm going to try to do this and as long as I stay up here. I want to show you the relative rotation graph and show you what happened back in 2021. Now, for those that remember, 2021 in November and December, we were hitting all-time highs, and everyone thought that the market would never stop going up and would go to the moon. So this is a rotation graph that actually will show you, and the ones that I put on here are the aggressive versus the defensive sectors. So the Qs is the NASDAQ, discretionary XLY. That is an aggressive sector. XLK is technology. IWM is small caps. And over here is communication services, which is where the internet stocks are. XLP is staples, which is a defensive sector, and utilities is the most defensive sector normally, and then real estate as well. So I'm going to show you how these things, this will give you a sense for rotation. Now, the way this graph is set up is it's based on the S&P, so that's the benchmark. Think of that as right in the center. So everything to the right of the center line is greater relative strength than the S&P. So everything over here on the right, either the top or the bottom right, is better relative strength than the S&P. And everything to the left, of course, is worse relative strength. Now, the center line that goes horizontally across is momentum. So everything above that line has greater momentum, and everything below that line has less momentum. So clearly you want to be in the upper right, but even the lower right is okay. You do not want to be in the lower left, which is lagging. So right now we have it set at November 4th, 2021. So I'm going to move this as we go along and watch how these things change. This will give you a sense for rotation. What Wall Street is rotating, usually when they foresee that the market's going to start to go down, they move out of aggressive and into defensive areas. Typically, a lot of the big brokerage firms cannot go to cash. So they have companies that have 401ks and things like that. They need to be invested somehow. So if they want to be defensive, then they move it to defensive sectors like staples, utilities, and real estate. And then if they think it's going up, they move them back into aggressive sectors. So let's watch how this rotation goes along. You can watch the dates right up here as I move to the right. So now we're moving into November. You can see XLY, the small caps, the Qs, they're all up in the leading area, but they're moving down. And now XLY is moving down into the weakening, and so are the Qs, NASDAQ. XLK is starting to move down as well, and small caps are already down there. They're still in the right-hand side, but notice on the left-hand side, the defensive sectors are starting to make a move. You can actually see it just by looking at the tail right here. So we're still in November. The market was still making all-time highs. It did so all the way into the beginning of January. But right here in November, the defensive sectors are starting to move. So as we move more to the right, so now you can clearly see rotation. So defensive is starting to move up even more. XLC communications is moving down, and small caps very rapidly moving to the lower left. Technology is hanging in there, and so is discretionary and the NASDAQ, but let's see how long that lasts. So we're in November right now. There's December 1st. So going through, there's December 6th. Now take a look at the defensive sectors. All three defensive sectors now are in the upper right-hand leading quadrant, even as the market was still making all-time highs. And the aggressive sectors are beginning to move down to the left. So we keep moving this to the right. Now we're in December 9th, middle of December right there. Now the only ones in the leading quadrant are defensive sectors. So again, the market was making all-time highs, and everything now is moving into the lower left. So now you can see small caps way over here. Communication services still really hasn't done much anyway. Here's discretionary, there's NASDAQ, and now technology is starting to collapse as well. But everything except technology is now on the left-hand side of this vertical line, which means they are all weakening. Their relative strength is less than the S&P. So let's keep moving a little bit more. I want to see what happens in January when the market started to collapse. If you remember, 2022 was almost the whole year was a bear market. So there's the defensive sectors are still over there in the right-hand side, and all the aggressives are in the left. And technology is starting to rapidly move over that way as well. So now we're at December 31st. And let's see what happens when we move into January. So now we're in January, and now you can see all the aggressive sectors are staying over here on the left-hand side of the chart. And the defensive ones are still on the right-hand side, which means they are outperforming the S&P. Keep on moving to the right. Now we're in the middle of January. Real estate's now moved over to the left. But now as we get towards the end of January, you can see finally communication services tries to catch up. But most of the defensive sectors are still over there in the far right-hand side. So this just gives you a sense for what happens. And these things happen even as the market was making new highs back here in November and December. So that's how you can tell what Wall Street is positioning for. By watching the rotation like this, you can see what's happening. All right. Hopefully that was interesting. One subscriber mentioned the Hindenburg Omen. I'll go look at that. It's on the charts page for subscribers, all the way at the very bottom left-hand side. David Keller, who is an excellent technician, he used to work for Fidelity and did technical analysis for Fidelity, just to give you a sense that technical analysis is not just for hacks. All of the big institutions use it as well. But this is the Hindenburg Omen, basically made up of three components. One is the NASDAQ needs to be above its 50-day moving average, which it is right here. The new highs and new lows are greater than 2.5%. So you can see the 2.5% line is this black line right here. So both of those happen right back here in the middle of December. It's rare for both new highs and new lows at the same time to be above 2.5%. And then the third piece is the McClellan oscillator, which is a oscillator that measures advanced declines in the market. So that needs to be less than zero. And you can see right here in December, it was less than zero. And more importantly, on the Hindenburg Omen, you can see how this big solid dark blue area in December, whenever you get clumps of these grouped together, that means all of these three conditions have been satisfied. So you can see they're satisfied in previous areas, but they didn't clump together as much as this. So the Hindenburg Omen has triggered. Normally that eventually leads to a downturn, but not immediately. So it's just an advance warning, just to give you a sense for what might be coming. You can see there was some solid ones right through here, and it took about another month for the decline to begin. So if this one here was in the middle of December, this could take another month or so for this one here to actually trigger and start to decline. So good point from a subscriber who mentioned that. Inverse ETFs is something that somebody wanted me to talk about. So if the market does start to decline in a serious way, and I have to emphasize serious way because we are in a secular bull market. And what that means is it's dangerous to try to short things when the market for the long term is going to go higher. So you need to have a really good idea that it's really rolling over and not coming back, because in a secular bull market, declines can happen, certainly, but they usually bounce back pretty quickly. Except for 22. If we do go into something similar to 22, which we certainly could, then that's a more extended downturn. And then these inverse ETFs can work pretty well. So I've got a list of them here right on the charts page, right next to the Hindenburg Omen, the lower left side. And what you can see is QID is short the Qs. So we'll take a look at that. And I put both of them side by side so you can see how they're basically a mirror image of each other. So the long component is on the bottom and the short component is on the top. So as the NASDAQ declines, as it has been, it's making lower highs and lower lows. That's the definition of a downtrend. At the same time, the inverse ETFs are making higher highs and higher lows. And so it's sitting right on the 50-day moving average, maybe getting ready to break out. But again, you don't really know. You can see back here in July, where we had this big downtrend in the NASDAQ for about a month. That would have been a good time to jump in to this one over here. Now, I always like to see the short-term indicator, which is when the 5 crosses the 21 right there. This one's to the upside. Remember, this is the short on the top, and this is the long on the bottom. So across to the downside down here. So that was the time to get out and maybe move into the short ETF. Right now, it's just beginning to happen. So if this continues, and if we really get a breakdown below some of the support areas, then you might consider getting into an inverse ETF. We'll look at the S&P, because the S&P has a pretty clear support level right down here at 580, which is 5,800 roughly. So if the S&P were to break below 5,800, then it probably is going to go down pretty rapidly. And that would be the time to get in up here. Now, you can certainly try to get in now, but as I mentioned, in a secular bull market, these downtrends can reverse very quickly and go right back up again. So you really have to be confident that the downtrend is really in place, but this is certainly one way to be able to play it. Now, I am going to make some changes, and since the market's closed tomorrow, I'm going to do this tomorrow. On the portfolios page, many of you know about this, the market timing strategy. There's an explanation of the rules right here. Here's you're really trying to get in on the long term. You can see back here when in March of 23, when this fired, it lasted for a year and was a double for the year. This is the 2x in 2x NASDAQ, not inverse, but 2x NASDAQ. So the NASDAQ goes up 10%, this goes up 20%. Somebody also said, why don't I just put my money in there and just let it ride? If I have a long horizon, let's say a 15-year horizon, or even a 5-year horizon, let's call it, then why put it in the single? Why not even put it in the triple Qs and just let it ride? And you certainly could do that. One thing you have to understand about leveraged ETFs, and to learn more about it right here on the website, there is a link to learn about leveraged ETFs. The important thing to understand is that they rebalance nightly. So every night they will rebalance, which means over the long term, even a medium term, you may not get what you think you're going to get. So these are some examples right here. Here's the Qs. This is the single, double, and triple in a bearish trend. So the market was going down and you were holding one of these. You can see what happens. So market started over here, ended over here. It was slightly down, but this went down significantly. So the triple means that you will lose triple too on the way down. So they're great on the way up, but you have to be very careful. You have to be very confident of the direction. So yes, you certainly could do that. One of the comments that the person made was, I can see where if I jump into this at the top of the market, then that could be devastating, and it can be. If the market goes down 30%, then this is going to go down 100%, almost 90%. Almost your whole portfolio is wiped out in that case. So again, you have to be very careful of what you're doing. Now I'm going to make some changes to this. I'm going to base all of this on a weekly chart, but stay tuned. That's coming. I'm going to probably work on that tomorrow. All right. So that's inverse ETFs. You can find them on the website if you're interested. Only one, before I go to that, since my internet seems to be holding out, I'm going to jump into the market bias and take a look at that real quick. You can see we had another day down right there. Only one green one, which was energy, switched from, on the short term, switched from a bear to a bull. And Bitcoin has switched to bears twice for Bitcoin. So if we look at Bitcoin right here, You can see right there, Bitcoin sold off again today, but bounced back. The whole market bounced back right at the end of the day today. So Bitcoin came back with it. Interestingly, Bitcoin is positively correlated with that triple NASDAQ, the TQQQ, which means when that one goes down, Bitcoin goes down as well. I'm going to extend this support line. You can see Bitcoin came right down, almost touched it right there, and then bounced back higher. So this could be a pretty solid support line. If it breaks through that, then it's likely going to be headed much lower, maybe down into 75,000 in that area. So be careful with Bitcoin, but looks like it's trying to make a run back higher. If we go back and look at the S&P, which is up here. So the S&P, same thing. There's a little hammer right there. We're seeing that a lot on a lot of charts today. They sold off in the beginning of the day and bounced back right at the end. If we look at the, let's see, do this a different way. Do the new sharp charts and look at my buttons over here. The 10-minute chart, you can see it right here. This is today. So went down, went up, a little above the open, went way below the open, a little above the open, came back to flat again, and then tried to move back up. So right at the end of the day, it tried to come back and move higher. So don't know what's going to happen on Friday. Friday is the jobs number. So really probably will be dependent on what happens with the jobs number. Again, if we go back to the charts page and look at the upper left, you've got recession watch charts right here. And here's the unemployment rate. Actually, I'll look at the initial unemployment rate with claims. And that shows you right here the unemployment rate. It's forecasted to come in at 4.2, which is what it was last month. And here's the rate, Fed rate cuts. So they continue to cut down to here. They say they don't want to cut anymore, so that one's going to go sideways. And up here is the initial jobless claims. So what you can see is the unemployment claims have been dropping substantially. So I wouldn't be surprised to see the unemployment rate actually fall, maybe even go down to 4.1 on Friday. That would actually be positive, I think, for the market if the unemployment rate fell. There's a lot of other things that go into it. It's not just this, but this can be a good indicator. I also put together a chart that shows initial claims along with continuing claims. So you can see initial claims actually are starting to move up, where continuing claims are moving down slightly. But the initial claims, if they continue to move up, then continuing claims are going to move up as well. Again, the unemployment rate is right up here, forecast to come in at 4.2. So we'll see what happens. So anyway, that's Friday is going to be important. Tomorrow the market's closed. So anything that happens with the market at the open on Friday is going to be based on this, the jobs number that comes in. So if there's something that the market doesn't like about it, it's going to happen right in the beginning, and the market is going to move whichever direction it feels it wants to. If we look at the Santa rally and the indicators, we have now completed number 2. First 5 days of the new year was actually up 0.6. Interestingly, if we look at each of these alone, the Santa rally, which is between these two lines, actually was down. So it was down 0.5. And the first 5 days of the new year was actually up 0.6, almost a wash. But interestingly, the first 5 days actually ended lower than where the Santa rally began. So even though we've got one lower and one higher, the trend is actually lower. And you can see where this trend line, which I've had in here for quite a while, this trend line, it keeps going up and hitting it. And as soon as it does, it gets rejected and sent right back down again. So it looks like it's starting to move back up. It looks like it wants to move back up. We'll see if that can continue. We've got lots of things coming up. CPI will be the week after that, as will the options expiration, and then the Fed meeting at the end of the month. So we need to watch out for all of those. In fact, for those that get my newsletter, I put this last weekend in the newsletter, the calendar. So here's the calendar right here. So we are actually on the 8th right here. The 9th is now a holiday. Wasn't when this was created. And then CPI inflation report is on the 15th. Options expiration on the 17th. Then we have inauguration day, and who knows what's going to happen that day. I'm actually a little nervous about the market in general going into the inauguration, and then the Fed meeting at the end of the month. So lots of reasons to have lots of volatility. You can see going back to 1950 for election years. Election years actually are better than the normal trend. The normal trend is in the dark colors here. The blue is the NASDAQ. So the normal trend is basically sideways to slightly down, but during election years, it's actually slightly up. So we'll see how it's going to follow this year. And then one other thing I want to show that I've showed many times before, but this is how market cycles work. And this is really important to just visualize this chart. And I'll relate this to something in a second. But the accumulation phase is down here when a stock or the market bounces up and down and then breaks out, goes up, might have another reaccumulation right through there, gets up to the top and bounces up and down again, and then starts the markdown phase to start to head back down again. And this is the way markets work. So it's important to try to recognize that kind of pattern if the market begins to go in that direction. And to do that, I am going to show you, go back to the market bias page and look at the technology sector. And let's look at it on, try a 1 year chart. All right, so here is the markup phase. There was a accumulation phase down here, markup, very short distribution, mark down, and then another markup. And right now you can see it's going up and down sideways, just like that chart showed before. It's exactly what the distribution phase looks like. This is when all of the big brokerages and all the big traders, the hedge funds, this is when they sell to retail traders. So retail traders think that the market's just going to continue to go higher. So this is the opportunity to sell into strength for the big hedge funds. So that's what happens during the accumulation phase. No telling how long this might last. But at the end of an accumulation phase, you get another markdown phase like this. Let's look at this on a 2 year chart. It's not as apparent on a 2 year, but so that's something to keep in mind, something to watch out for. It's really important. One final stock is somebody asked me about was Lilly, and Eli Lilly is something that I put in the trend model. So you need to be a subscriber for this. If you click on the trend model for the Magnificent Seven Plus, it's not just the Magnificent Seven, but it gives you the short-term, medium-term, and long-term trends for all of these on the left. So the Magnificent Seven is on the top, plus Netflix, which should be Magnificent Eight, really. And then there are a few other ones like AMD, Supermicro, Oracle, Palantir, ones that lots of people have been talking about, and Lilly I added down here as well. So anytime something changes this week, it gets highlighted. So you can see Apple had a short-term down signal. Meta had a short-term up signal yesterday. Tesla just had a short-term down signal today. And Palantir had one today. So you can click on the charts on the left for any of these. And we can look at Palantir. So there's the short-term down signal right there. So Palantir is starting to move down. If this blue line crosses the red line, it will get a medium-term down signal. That has not happened yet. It's still a little ways away from that. But you can very quickly see what the status of everything is just by looking at this. So short-term, medium-term, long-term on the right-hand side, which takes a very long time to move. So if we look at Lilly, first thing you'll see is it has a short-term down signal since December 12th. It has a medium-term since October, but it's had a long-term up signal since 2021, quite a long time. So if we look at Lilly on a normal chart, here's the distribution phase. So this is exactly what I was saying. Here's the accumulation phase right there. And then it had a sell-off and a bounce back, and then another accumulation phase right through there. And now we are in the markdown phase for Lilly. And there are lots of things it has to do before it starts to recover. Number one, it needs to get above the 50-day. It made it above the 21 today. It needs to get above the 200-day. The MACD needs to get above 0. went below zero way back here, right during the distribution phase. So it has a lot of work to do. If we look at Lilly on a long term, which are over here, so the minus sign right here is a zoom out button. So we can look at Lilly on a longer term chart. You can see here, it's actually been in a long term trend for a very long time. It's not even on this chart where it started. It's way back in 23 sometime. But it just switched to a long term downtrend. And the MACD, the momentum is below zero. Normally what happens on long-term trends is it will bounce back before it continues lower. And that's true of the current market, by the way. If this market is going to go into a long-term downtrend similar to 2022, it's not going to do it in a straight line. It's going to go down, and then it will bounce back up, and then it will make a lower high, and then it will go down and make a lower low, and it will continue to do that, make continuous lower highs and lower lows. So it fakes people out because they think the recovery is starting and they jump in, but really it's just a head fake, and then it continues lower. So remember that. So this is the long-term chart right here of Lilly. It does not look good. It needs to get above this. It is still in the cloud, which is neutral, but all the momentum indicators are showing that it's still headed down. It's trying to make a recovery, but then finally, I also put in here the monthly chart. This is a very long-term chart. And you can see on a monthly basis, it is still above the 21 months. So that's almost a 2-year line right here. Came down and touched it right there. But you can see on the monthly MACD, the momentum, it is accelerating to the downside. So Lilly could bounce back. It could make a little cup right here and start coming back up. But the odds right now aren't too good, especially if the market continues down. So Lilly has a lot of work to do if it's going to recover. This is the zoom in chart. So this gives you a little closer view. And a lot of times I'll actually put the support and resistance lines and trend lines right on here. So you can see it here's the double top right there. There's the distribution phase in through here, made lower highs and lower lows. So it was on a downtrend here, and then the downtrend accelerated. So now the new trend line is actually steeper than the old one. Came back up today and touched it, just touched the downward trend line and the 50-day moving average and the bottom of the cloud. So right now is a big test for Lilly. It needs to break through and break out of these things, get above the 50, get above the 200, get above the cloud, get above this downtrend line here, which is at about 840. So right now it's at 787. So it's got about 50 points it's going to have to make up before it proves that it's back into an uptrend. For those that like to catch it when it's at its lows, this could be a good time to do it, but it could also just continue going down and go back to the lows down here at 710. So that's it. I don't think I would be a buyer of Lilly, but for those that believe in the company, and if you're a long-term holder, then this is just noise. You don't have to worry about anything. Just let it go. For long-term investors, you want to be looking at the monthly charts. So for a monthly chart, there's no reason to get out yet. There even wasn't a reason there. There was no reason there. There was no reason there or there. Right there might have been a little dicey back in 2016. But this is all the way back to COVID, way back here. So the final thing just to leave you with is on the homepage, which is available to everybody, is the secular bull market chart that I always like to reference. This is what you should always remember, that we are in a secular bull market that began in 2013. They typically last 18 to 20 years. So this one should last until 2029 or 2033, somewhere in that neighborhood. It is definitely extended, so it needs to have a pullback, just like it did in 22. So even with that bear market in 22, it never broke the red line here. It never broke below the relative strength up here, and it never broke below the MACD down here, right here, the zero line. So none of these have happened through this whole period since 2009, but the official year is 2013, because even though the market started going up in 2009, you didn't know if it really was going to continue higher until it broke the previous highs. So in 2001, with the dot-com crash, it went down here. 2003, it started coming back up, and you might have said, okay, that was it. That was the bottom. Well, it never could get back above that high. Of course, that was the financial crisis, but I can't tell you why or when or what is going to cause it, but something will, because secular bear markets usually last about 12 years. So if you knew that about secular bears, you would have known right there that it's likely when it hits this point, it's going to get rejected and something's going to happen. And something certainly did. But when it got here, it broke out, and that started the new secular bull, which could run till 2029, the anniversary of the 1929 market crash, coincidentally. Even COVID right here never closed below the red line. It traded below it. This is a monthly chart, by the way. It traded below it, but never closed below it. So in all these cases, it never went below that red line right there. And if we do get an extended downtrend in 25, it likely is going to come back to that red line again. And you can continue to watch this if you want to know if we are starting to go out of this secular bull and begin a new secular bear. Just watch this chart. Just look at it once a month, because it's a monthly chart. And just see where we are. You can see it's starting to maybe roll over a little bit up here, but it's got a long way to go before it actually signals that that's the case. By the way, on the bottom of this page, for those who want to subscribe to the website, you can sign up for $0. There's no credit card required. It just logs your email address, so you get notified when the newsletter is available. You can do a 7-day free trial using the monthly, and then just cancel, if you don't like what you see on the 7-day. And it doesn't give you everything, though. There's certain things that are not available on the monthly. And then the $99 for the annual subscription is well worth it. You can read all these testimonials if you want to. But anyway, okay, it looks like my internet hung in there tonight. So thanks for watching, and have a good day tomorrow. I will not be doing one tomorrow. I will be updating a lot of things, though, when the markets close. So keep an eye out for especially the market time strategy. Thanks, everyone. Have a great evening, and I will talk to you later.